I asked ChatGPT to make an investing portfolio that is likely to outperform as of July 2025. Today I'll be going through the portfolio this AI search engine has created, analyse these holdings with valuation models, and see if ChatGPT can create a killer portfolio. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So this is what I asked of ChatGPT. I said, make an investing portfolio of individual US held stocks to outperform. I kept it vague because I wanted to see what the search engine would do with that information. And first off, they've stated, creating a stock portfolio to outperform the market, which is typically represented as the S&P 500, requires balancing risk, return potential, and diversification. With no portfolio can guarantee this outperformance, I can build a high conviction portfolio of US listed individual stocks based on strong fundamentals, revenue and profit growth, margins and cash flow, industry trends, AI, semiconductors, health tech and green energy, reasonable valuation based on PE, PS and DCF, and competitive moat and management. Lots of things to consider when building a portfolio. So to kick it off, their high conviction growth and value stock portfolio, which is what they've titled it, as of mid-2025, has three separate categories or different valuations and balancing depending on how much money they want to put into each individual holdings. And here they have their core growth picks, which accounts for 60% of the overall portfolio. They state that these are companies expected to drive strong revenue and earnings growth due to secular trends. And their picks are Nvidia, Microsoft, Google, AVGO, which is Broadcom in the semiconductor industry, Amazon, and Meta. What I find quite interesting about these individual holdings that have been picked out as 60% of ChatGPT's overall core growth picks is that a lot of them are heavily weighted in the S&P 500. Here we have Nvidia, Microsoft, Amazon, Meta, Broadcom and Alphabet twice, making up around about 7 of the overall 8 top holdings in the S&P 500, with a weighting that's well over 20% in the index. One of the cool things about looking at these high conviction growth core picks is that even though they're heavily weighted towards the S&P 500, I think it has looked at growth and valuation in this metric. Here we have Google, which I would say is one of the core holdings that is fairly and attractively valued despite a good growth rate. Nvidia is one that is growing faster than the others but is highly valued. So I think it's trying to balance the lot. And also it's not got Apple here, which is heavily weighted in the index at over 5% of the S&P 500. And I think that's one that doesn't represent good growth rates and doesn't represent a good valuation right now. Now they go over their thesis for each individual holding. Here they say there's a few mistakes I would have said on this thesis perspective for the core growth picks. They've listed Microsoft as the leader in cloud with the form of Azure. They're not. They're actually the second highest after Amazon. And Amazon they haven't listed cloud at all, which I think is a bit strange. But there are some good things here. They've pointed out that Nvidia is the dominant AI chip manufacturer, which they are. They've stated that Google is attractively priced, which I believe they are on a price to earnings ratio, certainly. They've also pointed to a few different things like AWS's recovery, so i.e. like that's actually like their profit margins going way up in the past couple of years, which is interesting that it points that out. And it talks about Meta being undervalued versus growth, Instagram, etc. So I really like some of these picks. I think that all of them are potentially winners. There are a few that I would maybe take out, but it is ChatGPT's list. So now we can look to valuation of these core holdings and see whether they're likely to outperform based off the DCF analysis. Now I've tried to be fair with all the businesses, but I'm only human and may make decisions that you may not agree with in terms of growth rates and price ratios. So please bear with me and use your own sort of research if you want. But these are the businesses and how I've valued them. Now, some of them I've valued slightly differently than others, used different sort of their key metrics. I've used earnings for Google, etc. And some of them returned better than others. So here we have the outperformance and underperformance based off of a 9 to 10% market average, which has been the average in the past for the S&P 500. And some have outperformed and some haven't. Around about 3 out of 6 outperformed based off of just a quick DCF that I did to try and see whether these businesses were likely to outperform. What's funny is that the S&P 500 is very unlikely to return around 9% over the next, say, 5 years, in my opinion, because of current valuations. So I would say some that are maybe seen here to be underperforming are still maybe possibly going to outperform. But all told, I didn't mind this list. There's only one that I've really got a massive problem with, which is Broadcom. I don't think it's going to outperform at all. Whereas some of the others I could see outperforming despite my current DCF on them, and the likes of Meta. So I think that this is actually still a good list that could outperform over the longer term, with a lot of things going well for these individual businesses. We get on to what they call defensive anchors, which is essentially value or defensive stocks that account for 25% of the portfolio. And this, they state, is lower beta, strong balance sheets, steady dividends, helps in market downturns. These are essentially the companies that will be resistant during markets of quite a lot of volatility and bear markets. Here they've stated Berkshire Hathaway, which is a conglomerate, diversified exposure, huge cash position, great defensive pick. UNH, United Health Group Healthcare, growing healthcare spending, massive scale, stable cash flow. Costco, consumer staple, resilient business, and for some reason Pfizer, and they've stated optionally switch this for Eli Lilly or Merck. And I think that those two picks maybe would be solider ones than Pfizer, because I do believe that Pfizer is maybe a deeply valued stock, but it's not really got the same moat as the other three. So I would actually say that Berkshire Hathaway is a great one, but the valuation is questionable here. United Health Group is an excellent one, I would have said all round, and I actually have that one, so maybe that's just my own sort of bias. And Costco, a great company, but the valuation is really questionable right now. So some of these are great companies, but the valuation, I would say, is something that we maybe could contest. Now, I did the same with the defensive stocks for valuation as I did for the core growth stocks. Here we have some businesses that I can't really value that well, though, with just DCF models because of how they're sort of built, etc. Berkshire Hathaway is one of them. It usually works off a price to book ratio. It's not that best for trying to interpret that. I said it's likely to underperform based off its price to book being actually higher than it has been in the past, but who knows. I think Berkshire Hathaway usually buys back its shares around 1.2 price to book ratio, so I think that's more where I'd be aiming for with this one. UNH is one that I think is going to outperform around 15 to 17% CAGR. I own the stock though, there is bias there, but I do think that their growth rates for free cash flow based off of their current valuation in terms of price ratios is still undervalued. Costco, I think, is a consumer staple that is an excellent quality business. I really want to bet against it. Even though I've said underperform here, the reality is Costco is going to still compound, I imagine, and still deny DCF models. So what do I know? But I think these two businesses, Berkshire Hathaway and Costco, at fair valuations, are excellent ones for defensive value stocks. Then we have the likes of Pfizer, which is one that, again, I couldn't really do my best with. I said underperformed by about 6 to 8%, but its free cash flow is actually going down, not up. So it's hard to sort of value a company that's not actually growing that well. I don't think I'd choose this one for a defensive value holding. If I was going to pick ones, I think the first three are good ones to get at good valuations. And we have their small cap or Moonshots, which accounts for 15% of the portfolio. That's higher risk, higher reward with strong future growth catalysts. Here they've listed some strange picks, I would have said, for growth stocks, and I'll give some examples and maybe ones that I would have picked instead. Palantir is one that is always coming up. It's a big government and private contractors, profitable now. I would say it's an excellent business, growing really fast, over 30%, but the valuation is never something I can get on board with the price to sales of over 80. So I don't think that's really a great one at this valuation. And Supermicro Computer, SMCI. I've heard a bit about this one, don't know a lot about it, so that might be a good pick for growth stocks. Celsius Holdings, consumer beverage, explosive growth in health energy category. I think it's a good one for maybe growth in the health energy category, but I just don't like its moat whatsoever. And I think there's been a lot of questions around in whether this one can actually go for the long term. And quantum computing, I don't believe in quantum computing stocks really. That's a really long-term moonshot. I don't think it's even profitable as a business, so I wouldn't include that one. Other picks I would have chosen, maybe like Hims and Hers, which I have in my portfolio. It's growing at over 100% revenues, beating all of these companies. Strong free cash flow growth. It's a disruptor in its industry. Yeah, it's a moonshot, smaller part of the portfolio, but I think it's got a bit more runways for growth than some of these other companies. Robinhood is another one that's exploding lately, done really well. Maybe not now, but in the future could be a good small cap company to buy in this sort of environment. So I don't really necessarily agree with this small cap individual sort of 15% of the portfolio, if I'm honest. So the moment of truth, is it going to outperform? Well, they say the annual return goal is about a 12 to 15% CAGR, with the benchmark being the S&P 500 and the Nasdaq 100. A holding period of about 3 to 5 years, and a rebalancing should be taken in semi-annual. Now, to me, I think I like some of the picks, but overall, I think it's likely to maybe either underperform or outperform, but not really in the way you might expect. So I think this one is hard to value because the companies they're picking have excellent moats in some cases. I thought the core growth holdings were actually quite good. But in terms of their picks for moonshots, I thought that was quite hit and miss. I didn't really agree with some of their choices, and I would choose different holdings. And pretty much for their value stocks as well, at the current valuations, I don't necessarily agree with that many of them, and I would like to pick them up at better valuations for value-based holdings. So overall, I like their weightings towards things, but in terms of actually what picks they chose, it was a bit hit and miss. What do you guys think? Do you like these individual holdings? Let me know down below. And as always, thanks for watching, and I'll catch you in the next one.